So, good evening, everyone. Thank you once again for waiting, for showing patience. I will start this webinar now, and I'm sure a lot of people will continue to join. Before I begin, if you can hear me properly, if you can see my presentation, please send me a yes or a okay. Use your chat option to write yes or okay. If you can hear me properly, if you can see my presentation, although a copy of this webinar will be put on YouTube, so you don't have to worry about it. It's just when you're attending this live, it becomes much easier to ask questions. You can use your chats and you can ask your questions, and I'll try to answer as many questions as I can. And any questions, if I'm not able to answer, definitely somebody from my team will touch base with you and we'll do a live session for you and we'll try to answer those questions as well. So today's session is all about understanding what 2022 is going to bring. Because absolutely, we did this session last time when we were talking about 2021, because 2020 was chaos. I'm sure nobody has forgot about 2020 yet. So, and 2021 honestly was an eye opener. In 2020, we saw a lot of renewable sources of energy going higher, and then when 2021 started, we saw a lot of renewables going down, but energy prices moving higher. So today also we are going to understand what's the outlook on different kinds of asset classes, what we can look into, what we need to be careful about. We'll talk about 10 points which we have to see from consultant point of view, from client point of view. And when I say client, I mean my clients, basically investors. So from an investor point of view, what you should see, if you are a financial advisor, if you're a financial consultant and you have a client, then as a financial consultant also what you should see. We are going to discuss about those things as well. We are definitely going to talk about the outlook on gold. We are going to talk about outlook on pound, euro, INR, and stocks, equities, and what are the reasons that why we are expecting what we are expecting, and of course cryptos as well. I do have a live platform. See if this session interests you, and if you stay for the next few minutes and you want to go to the live platform and show you chat, I'll definitely do that. Let's keep this as a judgment call. If you like my session, and we'll continue with this. Now, we are going to discuss a lot of things, and I request anything we talk about, it carries market risk. I mean, everything we talk about, whether it is a strategy, whether whatever outlook I have, because that outlook depends on a lot of factors which are currently what I see the way I see. And it's not necessary that because pandemic was something which was uncalled for, so anybody who analyzed anything, gave any kind of prediction would have gone wrong because of the lockdown. So we don't know what's going to happen, but best we can do is whatever is the available information, we can try to make the best use of it, analyze it, and come up with a certain kind of outlook, just to ensure that if there is a path we are walking on, then at least we should be knowing that this is the entire Middle East crowd. So I think it's safe to say that if you are driving, you should know where the radars are. So all I'm going to do is point out where the radars could be and make sure that your vehicle goes at the right speed and avoid accidents, right? But at the end of the day, it's our responsibility to drive safe. And that's the point, that whatever I'm going to discuss about, please ask your risk experts as well before you take any decision. Talk to your consultants and only then take a decision. Now, let's understand what's been going on, right? We are talking about uh, the post COVID investor, how he or she looks at the current financial markets, because this is one of the most important things we need to understand, that what is going on with the post COVID era, right? And we are shifting from an era, as now we have started calling this, from the pandemic to endemic. Talking about the pandemic, there is a massive vaccine rollout. First wave happened, second wave happened. We have seen the news, third, I mean, talking about a lot for the third wave, but there's a lot of news that countries like Germany, countries like China, there are still a lot of cases going on, and restrictions have become more tighter. But as the world moves on from the pandemic, we are looking at 2022. Mostly overall, the economic growth will be slower, Inflation expected to be higher. Volatility will be too much. Volatility means the fluctuation in the prices will be too much. And at the end of the day, the stocks will be preferred. I mean, it is expected that the stocks might be preferred more over bonds. But as we say, that the environment is very uncertain. So we need to be very careful. We need to segregate and make sure that we do not put all eggs in one basket, right? Whatever investments we do, we have to ensure that some of them is put into equities, some of them into bonds, some of them into commodities, and make sure that we make a right kind of asset allocation, right? So the current era which we are dealing with right now, it is something which is, it is a mixture. Think about the companies, airlines, restaurants, hotels, resorts, right? Think about those companies. What happened to them during 2020? So if there is a post-pandemic bounce, should we be seeing at those particular consumer stocks? I'm talking about airlines, I'm talking about restaurants, I'm talking about hotels, resorts. Think about those companies. Would their earnings will be stronger compared to the earnings which happened during the COVID time? So a post-pandemic bounce, looking at those sectors. So in the end, you will see that I have highlighted something called as reopening winners, and that is also one sector which you should be looking at, right? So this is something what we are going to discuss today. And again, as I said, that there is a lot of ifs and buts, but then we have to move and take a decision and see whatever suits us the best. Now, starting with how central bank placed, what is the mood of central bank? So the current map which you see, look at US right now. uh, Central bank is in a very desynchronized mood. This is the data, the research which is from 8th November, so it's not really very old. We are looking at a very fresh data, and you can see that the central bank in North America and in India are very less accommodative, which means they're not very keen to keep the interest rates low. They're talking about a tighter interest rate policy because of the higher inflation. While if you see, mostly Russia's very stable, central bank is pretty stable, more tight somewhere near South America, right? And very more accommodative. So if you see China in blue, we recently saw in 2021 that there was the Evergrande crisis, the largest property company in China, filed for bankruptcy, and we saw that how Chinese equities, Chinese stock market suffered. And I'm sure a lot of you must have seen this also. So China is right now currently in a mood where they are okay to keep interest rates lower, inject more and more cash into the economy, and ensure that the economy survives. But if you see North America, basically US, you will see that the Fed is keen to increase the interest rates, hike the rates because of the increasing inflation. So this is the current mood. Somewhere central banks are lenient, somewhere they are very tight, somewhere they are slightly less accommodative. And when I say less accommodative, which means less willing to keep the interest rates low. uh, Stable accommodative or highly accommodative or more accommodative means they are okay to keep the interest rates low and inject more and more equity. So this is something which we see. And as you can see, China and Australia both. So where China, the central bank is more accommodative, uh, in Australia also, if you see, there's a stable accommodative, which means central bank is okay, because Australia and China are major trading partners, and a property crisis in China. In fact, China is the manufacturing; it is the backbone of the manufacturing. So if something happens in China, it has a kind of ripple effect. So that's why the central banks in China are pretty lenient. But when we talk about US, the situation is completely opposite. So this is something what we'll keep in highlight. At the end of this section, I will talk about 10 things which you should remember as an investor and what you should eye for in 2022 after we go to the outlook. And please continue to ask any questions you have, use your chat options, and we'll continue to see this. Now, let's start with the commodity outlook, friends. Talk about gold. Okay, let's try to make it more and more interactive. So I'll continue to use the poll option here. Um, do you invest or trade? Oh, in fact, I should um, write it like this. What do you do in gold? Long term, invest, or trade, or speculate? Let's see this. Okay, preview, publish. I've started one poll, so just want to make sure that things remain interactive and you do not get bored. This is one of the most important sessions. This is probably the last session for November. So just answer. Use this poll and see. Do you invest long term in gold, or do you trade or speculate? Those who don't do anything in gold, you can still go for long term investment. I'm sure someone, a lot of you must have just bought gold and kept it for a longer period of time. It is surprising. Every time I start a poll, it becomes really very close. Something like this, it's always 50-50, 60-40. But yeah, I see gold is something which we cannot be away from, right? Gold has not only it is not only just an investment vehicle, but it has a kind of intrinsic value because a lot of emotions are attached to it. Whether it is about weddings, whether it is about gifts, whether it is about tradition, gold always captures it. And this is really important. So just I think 10 more seconds. I'm going to keep this poll open, and then I'll just end the poll to see the final results. So if you're joining now, please vote. I see a lot of people who are joining right now. You can see the poll with you. What do you do in gold? Do you long term invest it, buy and hold on to it? Or do you do daily trades, trade or speculate in gold? Whatever you like to. Okay, I'm ending this poll now. So 58% people said long-term investments, 41% said trade speculate. Again, a very, very close. So the point is, all of you are familiar how gold can move. And that is why it is really important for us to understand that what is the outlook of gold. Now, a common investor, what they must be knowing about gold right now is that because of US talking about a high, increasing the interest rates, reducing the stimulus, start tapering, everything, gold prices might drop. But that's where there is a difference, what we need to understand about gold. Because gold is not now just an investment vehicle. As I said, that there is a lot of emotions. Um, Gold market, it continues to trade near a 5 month high. There was a breakout rally. It was, I mean, it went up also, but at the time again started coming down. And we saw a lot of banks, a lot of analysts, they lowered their 2022 price forecast. So this is something what I have to tell you is because when I was doing a lot of research, a lot of banks, they reduced their forecast for gold. If you see Swiss Bank, for example, they lowered it to $1,850 an ounce. Earlier, their forecast was $1,900, but now it's around 1850. So this is something which we have to understand for gold. It is not just about um, falling down or connecting with the interest rates. Gold has built a support around $1,700 an ounce. Okay. Now, if you look at 2022, gold could be the metal you could follow in 2022 because next year begins almost 24 months removed from the start of the pandemic. So, if we see the 2021 bounce in industrial metals versus the decline in the precious at a greater risk of reversing. So, if you see it totally, like the top performers of 2021 right now, and if you compare with 2022, we'll see gold probably outperform in 2022 as compared to 2021, right? If you see silver also, it has been pretty much underperforming in 2021. It went down with copper because copper also went down, silver also went down. So when we talk about 2022, uh, copper and aluminum are still at the highest, but gold still has a lot of potential to rise because bond prices are also expected to go higher. And if you see the latest bull market after hitting all new time high, I'm sure all of you must have seen 2020 how it went. And gold went on to its highest 1920, 1950, almost 2000, right? But if you still see gold, In 2020, it went to the highest. In 2022, it might further continue to outperform. And the whole point is, if you see different kinds of reasons and understand, uh, look at this chart which I'm showing it to you right now. It's on the presentation right there, and there is a strong breakout expected. So if you see at the just at the end, the downtrend of the gold, that tip is still touching on the trend line, right? That's where it is. And if it crosses, it breaks that trend, the 2022 early might be the point where the gold reaches to a new high. And if this is the beginning of a powerful rally, then gold should slice through $19-20. And this is November right now going on. We should definitely see by the end of the November if it crosses to that level. Okay. And when we see what's going on with the central bank, so the whole connection is that if interest rates goes up, dollar becomes stronger, gold might come down. But the Federal Reserve's transitory inflation story is kind of dead at this moment, because a lot of people, they are still investing into gold, they are still buying gold, and there's a lot of investment demand also. So this is what we have to understand. A lot of, and this was back in 2021 also, when we were talking about what how gold is going to perform. When we compare investment demand versus consumer demand, even if there is not much consumer demand, but investment demand has continued in 2021. So for gold, we're expecting to be bullish. The price is expected to remain higher. It has a great support at $1,700 per ounce. So when we are looking at for the entire 1 year, if it breaks below 1700, then we might see a decline, but 1700 holds a very strong support. So entire 2022, especially the first 3 to 4 months of 2022, you might see gold remaining on the higher, uh, probably might cross $1,900 as well. So just keep a check on the gold prices. Do not get caught up in the story that if central bank is going to increase the rates, dollar is going to get stronger, gold is going to go down. Because the first half might be true, but it doesn't mean that gold will diminish, right? Because there is still a lot of uncertainty angle which is there. Now this is one thing. We are talking about gold. Let's understand another commodity, which is crude oil. Now again, since we are talking about it, let's have another question, and I'm going to reset this poll. Do you trade in, okay, or do you trade or invest in crude oil? Yes, no, um, another energy commodity. So strong poll, preview, publish. So there is a small poll again. Do you trade or invest in crude oil? Have you traded? Have you invested this year, last year, a year before that? Or is there any other energy commodity like natural gas, for example? So just to tell you, there was a major, there's still, however, a major energy crunch which is going on through Europe. There's a lot of supply disruption, and that has pushed natural gas prices higher. That has pushed crude oil prices also higher. So that is something which we need to see. Since the third quarter of 2020, global consumption of crude oil and petroleum products has increased faster than the production. So consumption is going higher uh, since the third quarter of 2020. More consumption than the production, lower inventory levels, and oil prices have gone higher. If you see in October itself, we saw Brent prices went up to $84 per barrel. WTI prices were around 81. Now, this is something which we have to understand, because since 2014, we haven't seen those prices, right? So, this was something which was really important. Now, for 2022, we still see the inventories, the oil stocks will continue to be lower, whether you see globally or you see in US. And this is reason why we have seen that the crude oil prices have continued to go higher. um, Now, over a period of 2022, there is an expectation that the market will be more balanced. The supply could be more balanced. And we are not expecting that the oil prices will drastically fall. This outlook should be more of a neutral outlook. Why I'm showing it on the downside is that whatever the current price is, I think the best price for oil where it suits, it is around somewhere 66 or $67, or somewhere around 70, $72, probably a better price. So if we see, uh, say, if even if, let's say, the crude oil consumption, it exceeds the crude oil production for another 4 or 5 quarters, right? Let's say from 2020 and continuing to 2021 and then 2022, uh, we'll still see probably that the supply and the consumption over a longer term period will get balanced. So this is not something where we are expecting oil prices to go continuously high. We are expecting a decline, but then decline is more of an average price of probably 66 to $70 is something what we are expecting. So I should be giving it more of a neutral outlook. Anybody who invests in oil, I see 83% of the people, they do not trade or speculate in oil. 8% do, and 8% do in another different energy commodities. There are a lot of opportunities in natural gas as well, because natural gas prices went up really high in last 2 to 3 months. So we make a lot of strategies in a different session. I will explain you what kind of strategies also we make. But for now, let's understand the short and long term outlook. So the negative which you see is a shorter period outlook, where we see oil prices might decline since the consumption and production starts meeting together over longer term, and then slowly and gradually will remain stable. So it's more of a neutral outlook for oil. We are not expecting oil prices to go to 100 or 110, because it already touched 81, 80 around in October. So we are expecting a steady market for oil, which is much better than 2020, which is much better than 2021. And as I said, when I started this session, we highlighted on few points that inflation might be continuing to go higher, but the economic growth might be slow. So that's why we are keeping oil as a neutral outlook, because this is important when we will talk about energy stocks. All right. And then let's talk about the important thing, dollar. Now, the chart, what you see here, it's important to see. Right now, dollar is at a very strong point. Um, the is a lot of talk about how inflation is expected to remain way above the Fed's target. Okay, see, it could be stable, but at the same time, the target of Federal Reserve, the central bank, which is 2%, when we talk about Fed's target, there is a possibility that it will still remain higher than the Fed's target. And it is not something which is transitory. When we say transitory, which means that just because the lockdown got over and people were out and about, business started. So all of a sudden there was inflation, because that was the Fed speech. What it was, that it is a transitory inflation, it will not last. But now, even that transitory story now is completely dead. We see inflation growing, and we'll see probably to remain stable, but way above the Fed's target. So dollar is expected to be stronger, because central bank will take steps to increase the rates and make sure that the inflation do not go too high. An increasing number of policymakers, they are really confident enough to put inflation ahead of growth concerns and embark on monetary tightening cycle. So when I say monetary tightening cycles, that means to keep interest rates on the higher side, not on the lower side. So that might make dollar continue to grow strong. So if you see right now, also look at this chart. Uh, there is a lot of supply disruption even for dollar. Also, there's a pent up demand. A lot of households have saved, right? So now the consumption have continued to go higher. Just exclude the food and energy, the consumption inflation has gone up to 3.6%. And if you compare 1990 and now, this is one of the highest numbers, right? So now the point is, supply continues to pressure, worker shortages, inflation might gradually ease, but at the same time, it's a gradual process. Throughout the 2022, it might continue to go higher, and central bank might take steps to control it and continue to increase the interest rates in 2022, right? And in 2023 also. So this might again, there are a few people, I received a question that with high interest rates, wouldn't this affect the stock market? So this is a very good question, because when interest rates get high, that means the cost of borrowing is expensive, which means businesses will borrow less as they used to before. So it affects the economic activity. Now that might be something which it might happen, right? There could be market shocks, but then central bank can mitigate this risk through effective communication and warning. So if central banks uh, if central banks speech or their communication to the market is more transparent, if they are already talking about increasing the rates what they have done in 2021, then these market shocks can be less destructive as we are looking at. So this is something which is really important, guys. Looking at the inflation is really important. Inflation is displayed through consumer price index data, which is available. So you can always keep a check on inflation, because that will decide the course of central banks rate hikes over a period of time, and that will decide the fate of dollar also. So we're expecting dollar to remain stronger, followed by, so dollar is expected to remain stronger. But when we see euro against dollar, we are expecting that the inflation in euro area, it is expected to go down, because earlier the forecast was higher, somewhere around 2.4%, but in 2022 we are expecting inflation to go down. So that itself, if we see, and euro doesn't want to repeat the same mistake what they did in 2008. So when the recession hit in 2008, they reduced their rates to make sure that the economy remains stable. And the moment they saw some stability in 2011, they increased the rates, which again put Europe into a recession. So now we are expecting euro to remain lower. We are expecting euro central banks also to keep interest rates lower or similar. No surprises here. The eurozone is still expected to run a negative output gap for the GDP, and the European Central Bank also has made it pretty clear that it does not want to repeat the mistakes that happened during the tightening the policy in 2008. So this is something which you're expecting euro to remain on the downside against dollar. The only scenario for a stronger euro dollar would be a strong global recovery and a eurozone renaissance as in 2017, or if US central bank all of a sudden says that we are not increasing interest rates. So there is a lot of ifs and buts for euro to grow stronger. So that's why we are expecting that these are too many ifs and buts, and euro might continue to remain on the lower side. So this is one of the most important reasons that why we are expecting that euro will be on a downside this time for the 2022, followed by another important currency, pound. So we are still remaining neutral on pound, because there are different schools of thoughts. um, Pound is up by more than 3% this year. Now this is really important, because pound recovered not only from Brexit agreements, which was a big uncertainty, from COVID impact, a lot of things which happened in UK. You still see pound recovering, right? Now, there is a possibility that the Bank of England is expected to. Now, there are two schools of thought. So let's talk about people who are expecting pound to be declining. So their argument is very simple, that the central bank is thinking about increasing the interest rates. What happened with European Central Bank in 2008 during financial crisis, Bank of England might repeat the same mistake of increasing the rates too early. This is a popular school of thought right now against a weakening pound, because that might put UK again into recession. But the point is, there is a difference between what happened with Europe in 2008 and what UK is about to do. Uh, there is no clear signal that UK might go into recession in 2022. So it is still expected that if Bank of England increases the interest rate, there is still a lot of cushion for pound, even if it remains stronger. It might not impact the economy too much. The external environment could become tougher with high US rates, but UK does not look as vulnerable as people would think. So this is something which is not going to bring too much adventure in your portfolio. Pound remains neutral. A lot of people in the money markets, they are thinking that the interest rate hike may not be too adventurous. Even if it increases, it might not impact the stock market too much. And at the same time, if US central bank increases the rate, a strengthening dollar may not affect a pound too much as compared to euro, because euro economy is still vulnerable, but UK economy is not that vulnerable right now. So we are maintaining a neutral outlook on the pound, not going too high but not remaining too low, pretty stable for 2022. Please guys, if you have any questions, continue to ask. I'm getting a lot of questions and try to answer most of these by the end of this session. So we will come into the stocks also. We'll talk about different currencies as well, and we'll definitely talk about what are 10 things which you should expect. What are the 10 things which you should eye as an investor, and what are the key risks by the end of but during the 2022 fact. Japanese yen, expecting yen to remain weaker against dollar. There is still the GDP is still expected to have a negative output gap in 2022. Pricing power is weak. Uh, Japanese yen has been the worst performing G10 currency this year. Um, Again, as I said, a higher US interest rate is most important. It might impact yen also, because dollar is expected to get stronger against yen. So the USD JPY as a pair, it is expected to go towards 120 potentially next summer. This is something which is expected. And dollar yen has still a very strong support around 115. So we are expecting yen to remain weak for the next 1 year. Look at INR. So a lot of people last time, because I did not include Indian rupees in my last outlook when I was doing 2021, and then I did one-on-one sessions with a lot of investors to give them a slight idea. Now we are going neutral with INR, but to be fair, I wouldn't be surprised if rupee falls towards 76 against dollar and go on the weaker side, because there are two schools of thoughts. Why I went neutral on, because there has been a lot of FDI equity inflow, which means the Indian stocks have been in a lot of demand. If you see the fiscal year, which started in April 2021, so that fiscal year throughout, what we have seen, there has been the increase of 168% FDI equity inflow between April to June, and that was the first quarter for the fiscal year 2022. Now, that what does it means? It means a lot of foreign investors have started investing into Indian markets, right? Now, this is something which was with in the favor of Indian rupee. Expected Indian rupee will not go as weak as it is, because there is a lot of FDI inflow. But and there was also a lot of talked about that how RBI would be there to make sure that the inflation is under control. But at the same time, Credit Suisse, if you see, they are expecting USD INR to climb above 76 in 2022. RBI might allow more rupee weakness. And as I say, um, if you see from a different point of view, oil prices have continued to grow higher in entire 2021. So that has impacted rupee also. The first 3 months of this year, the India's current account deficit also went higher. Economy slowly recovered. Uh, there are again different schools of thoughts. People are talking about a lot of analysts, they see that the rupee might reach 73 against dollar by the end of 2021, right? But in the longer term, it is expected the rupee might get weaker to 75 against the dollar. Uh, FDI inflows, these foreign investors buying Indian equities, that is expected to make rupee remain more stable, right? But again, as I said, there's a lot of uncertainty around global growth, US increasing the interest rates. So that might be again one of the important reasons that why we might see INR getting weaker. And again, energy prices is something which we have to keep into our account. So right now, the INR outlook is at the moment very neutral, not expected to be too weak, but at the same time, not to be expected acting stronger, because there is very less reason to be strong. The FDI inflow is already priced in. There is a lot of volatility right now also. So in the near term, we might see rupee appreciating a bit, but then again by the end of the year, it might go back to 74 or 75 or at least to 76 as well. So be careful with that. Somebody pointed it out, also closely connected with the oil process. Exactly. So the INR outlook, as I said, because oil prices, we are not expecting to go very high. It already touched 80, 81, and over a period of 2022, the economic growth is supposed to be slower rather than, going too strong. So that is also one of the reasons that we are not expecting very big action in the oil prices. So that's why we are keeping INR as neutral also. Now comes to the equity market. Stocks is one of the most important things right now. So if we see the indices, they continue to trade near the highs, driven by better than US retail sales number at this moment. Um, Holiday season, December is coming, Boxing Day, Christmas. So it's expected to be a solid end of the year, and indices expected to be on the stronger side. If you see the stronger consumer demand, supply chain is easing right now. The lockdowns have been removed, so the supply bottlenecks are getting easier, uh, removed, which is a very good news for the stocks. We are looking at US and China relationship getting stronger. Joe Biden's meeting Xi Jinping. Again, they have agreed to cool down the tensions between two countries. So, from a fundamental point of view, again, a strength for stocks. Now, US is expected to announce a decision in the next few days about, again, if we see how much how much interest rates hike they are talking about. If interest rates continue to stay lower for the longer period of time, if that happens, it might push US stocks higher. But if not, then again, might be on the lower side also. So the whole question is, will the bull run continue? So, as per now, over the next few months, including December, including the first 3 months, we might see stocks performing well due to the continuous talks between US and China, global supply chain and consumer demand pending up, and at the same time, the better US retail sales number. The fundamentals are supporting towards a good US equity. But again, when the interest rate hike happens, that is something which needs to be talked about. Look at the emerging market outlook. Now, emerging markets are markets like China, South Africa, India, for example. So in China, there was a lot of so if you must have heard about what happened back in China, there was a lot of technical regulation which all of a sudden started. So all of the tech stocks, it went down because the regulatory authorities, they tightened up the regulations for the technology companies, and we saw a lot of tech stocks like Alibaba, Tencent, Tal Education, a lot of tech stocks coming down. So that regulatory clampdown is threatening to shift trend growth in the world's second biggest economy to below 6% a year. So, and I said this to all my investors, because a lot of investors through 2021, they were very skeptical. Stocks like Alibaba was at such a great price at $140, $160. And every time somebody would ask me, should I buy Chinese stocks? See, you have to have a really lion's heart, because companies like Alibaba, great companies, but due to high tech regulation, we saw Chinese equities coming down. So if you're going long term, you can buy these stocks, but think about a very long term, possibly 2 or 3 or 4 years, because currently China is a very hot plate. It's a very hot plate. If the regulatory sector goes any more tighter than what it is, then then that's a problem. You don't want to be invested into China. Dollar has been edging higher for the last 4 weeks. That would weigh heavily on countries like Brazil and South Africa, since their index composition consists commodity oriented stocks. So a lot of emerging market like Brazil and South Africa, they so South Africa is a very commodity oriented country, right? A lot of companies, they are commodity based companies, so a higher dollar, a lot of times it impact the commodities and thus the companies and the index. Indian markets expected to face some correction, and when I say correction, that means a little decline owing to a stronger dollar, higher valuations. However, it appears to be a good buying opportunity on the dip. So India is buy on dips. Again, as I say, that a lot of people who would normally invest into China today, if I'm talking about emerging markets, and if somebody wants to invest into emerging markets, um, at this point of time, look at the emerging markets. If you're not investing to China, a lot of people would go towards emerging markets like India and South Africa, right? So a lot of investment from that also. There is a question that what happens. Same is happening in India, like recent Paytm, a lot of startups. So that's true, right? Since you're talking about Paytm IPO, I'm sure a lot of people would have this question that what's going on with the Paytm IPO. Started with 1950, went down to 1560, and at this point of time, it is. So I wouldn't be surprised if Paytm stocks comes down to 1260 also, because right now 65% of revenue for Paytm comes from UPI, which is an Indian government based payment channel, and it doesn't have any merchant cost. So, and whatever Paytm has at this moment, if lending services, banking services, it is not giving Paytm enough revenue right now. So Paytm as a stock, I wouldn't be surprised if it comes down to uh, down further down. But once it gets its proper banking license and becomes more competitive, I think that is something which you should definitely look at. Again, there's one question about, sorry, once here, what's going on with Taiwan. So again, Taiwan is responsible for uh, semiconductors, a lot of semiconductor based chips, the market chips, which had a lot of shortage. You must have seen iPhones are not available at the moment. Very few iPhones are available. The previous models are not available. There's a lot of supply disruption. As of now, the Taiwan stock market, uh, it kind of is on a winning streak at a moment. The global forecast, if you see for the Asian markets, it's still negative. And I'm talking about Taiwan, I'm talking about China, because there's still a COVID-19 concerns. Because when I started the session, I told you about how there is a renewed COVID concern in the Asian markets about China, if you talk about Germany also for that matter. So, because of this, crude oil prices, we have seen a slight decline. European markets also, if you see, it has come down. US still mixed, but then Asian markets still very vulnerable at this point of time. So we have to see the current outlook is still downside for even for Taiwan as well. For most of the Asia-based markets, I'm talking about China and Taiwan especially, uh, because the renewed COVID-19 concern, it will weigh on more on the cyclical stocks. Cyclical stocks means mostly the ones which are um, which are not defensive companies, like uh, FMCG companies are defensive, non-cyclical. At any point of the economical phase, you always buy those companies. But when comes COVID-19 concerns, it affects cyclical stocks more. So if you talk about Austria, for example, it has announced a full national lockdown. Germany has announced more restriction right now. So even for Taiwan, also currently, if you see the export orders, unemployment, uh, we saw exports increasing in September for Taiwan. Jobless rate was around 3.9%. They still have to announce their export orders numbers for this particular month. Even the unemployment rate they need to announce. But mostly, as I said, we will see that how the COVID concerns go for Asian economies, and if it gets renewed like it happened last time, then it might be a very, so that is one of the reasons that why a lot of investors would look towards India. for the same reason. A lot of startups, a lot of movement in the Indian stocks. Uh, so always keep that door open. Don't be go completely global. You can invest in a lot of Indian ETFs also. And even if there is any correction, the valuations are high. Probably it's a good buy on dips at the moment for the Indian markets as well. And as I said, that the beginning of the fiscal year 2022, there has been a lot of FDI inflow, increase of 168% in the FDI inflows. A lot of foreign investors investing into the Indian equities as well, along with US, as I said. Bond market, there's very limited opportunity in the fixed income products, basically bonds. Uh, Maintain a small preference for developed market government bonds as a volatility. So if you're a person who is older, not working at the moment, obviously bonds are your better option. And as the volatility when we see, uh, but be more inclined towards a higher quality segment, because try to get higher quality bonds rather than high yielding bonds. Okay, make sure that your risk is managed. Even in the high yielding one, selection is the key. Exposure is low given the tightness of the spreads. Prefer high yield and emerging market hard currency bonds over local currency. So look towards dollar denominated more rather than local currency bonds. And again, as I said, there are a lot of emerging market bonds which are available in dollars. So if there are Indian bonds which are available in dollars, probably that could be a better idea, right? If there are, say, Brazilian bonds, probably in dollars could be a better idea. So when you're looking at emerging markets, because emerging market bonds have a higher yield, it has a higher risk also. But if you're doing that, please make sure that the currency which you're taking is mostly dollars and not their local currencies, because dollar is expected to outperform in 2022 against most of the currency pairs. Now comes again the question of the hour. Somebody just wrote also that I haven't discussed about cryptos yet. Yes, you will be surprised. In 2021, we did not have cryptos in the outlook because it wasn't making a stronger case to improve put it as an asset class. But now a lot of people are interested in cryptos. So as of now, we have seen that Bitcoin, Ethereum, they have come down. Bitcoin was not able to sustain above 60,000. Ethereum is around $4,400, which is tough to cross it at the moment. Cardano, another currency which took a very good high in 2022, taking a support at 1.75. Stellar Lumens is doing a partnership with a lot of digital payment companies. So that is something, again, which you can look at. El Salvador became the first country to announce that Bitcoin will be accepted as a legal tender. The total crypto market cap has increased. Of course, high volatility, Bitcoin and Ethereum fundamental side of cryptic ecosystem remains neutral as adoption to new highs. It would be completely stupid of me if I would tell you that buy crypto is going to go higher. I'm sure everybody at this point of time remains neutral on cryptos because there is so much of volatility, right? I would still stand by what I said during throughout all my crypto sessions, that as an investor, please do not invest more than 5% of your investment amount in cryptos. It will be completely irrational until you are going for a very high risk investment. It is not advised from my point to invest in more than 5% in cryptos of your entire investment, because blockchain, probably a good idea, a good technology. uh, Cryptocurrencies, again, it is supposed to solve the cross border transaction problem. But as far as the regulations are concerned for cryptos, 2021 just passed by. Yes, there were some progress, but then 2022, a lot depends on the Bitcoin regulation, whether it becomes expected or not. And that is what going to keep the crypto market really, really volatile. So just be careful. Yes, there is a lot of institutional interest now. A lot of corporates have started buying cryptocurrencies. You must have seen how Tesla continue to uh, tweet about Dogecoin, Bitcoin, Cardano, and this is something which is keeping your portfolio very adventurous. But I would stand by what I'm saying. Please do not invest more than 5% of your total investment amount in cryptos. It's a really, really risky investment, and we are putting a neutral outlook on crypto right now. We don't want to give you a bullish or a bearish outlook, but as I say, crypto is really, really volatile, so be very careful with that. The cryptos which you should keep a check on: Ethereum. I am personally looking at Ethereum a lot because Ethereum has come up with a technology called smart contracts, and this is something which is a set of automated programs and instructions. Ethereum is like internet for the crypto market. So do focus more on Ethereum if at any point of time you want to look at the cryptos. Cardano is a very sustainable crypto, so look at Cardano as well. Stellar Lumens, something like that. Do not waste your money on Doge coins and meme coins, please. That is something which you really have to be very careful about. A lot of investors would ask me, should I buy Shiba? Should I buy Dogecoin? These are just parries. These are not something which is going to solve a problem. So this is just a kind of a meme. So be more careful. Try to invest. Try to look more into cryptos which can make a change, like Ethereums and Stellars and Cardanos, or Monero and Dash, for example. So this is from the outlook side. Now let's see some trends which will continue in 2022. 2021, we saw a lot of movement in electric, the EV space, the electric vehicle space, digital health data, internet traffic, genomic sciences funds, digital payment ETFs. So this is something which is again in 2022 expected to be higher. Some growth trends which we will see. EV space, I'm not sure how many of you. I did one session on 100 Talk FM, and we talked about how electric vehicle space is increasing. And those who think Tesla is too expensive, that time I talked about a company called Lucid Motors, which was at $21. And then I was checking the other day before I traveled, it was around 41 or 42. So keep a check on the EV space. A lot of people are talking about it. A lot of investors, they are focusing really strongly on the EV space. At the same time, we are living in a world where work from home status has continued. So anything which is technologically innovative, like imagine a remote medical consultation without even looking at the doctor, a 24/7 available medical consultation just at your doorstep using a phone call. So those kind of companies can really make a good sense. Or think about companies which are focusing on reducing the speed of internet traffic. So that is something again which is really, really important. If these are some funds and these are companies which are available, think about DNA sequencing. Decades ago, I mean, not just decades ago, if in 2003, if you have to sequence a human DNA to find out a disease or do some research, it would take at least 10 years and billions of dollars to do that. Now it might just take 3 hours and $500 to $600 to do a human DNA sequence, and that can be useful to identify diseases like cancer and take a step to make sure that you are a step ahead of these kind of things. So there are companies which already are into these areas, and all I am telling you is that towards 2022, try to open a leg of transactions towards this particular sector also. So we talked about Indian equities, we talked about currencies, we talked about commodities, we talked about US companies, we talked about emerging market bonds as well. This is one more leg which you could be always open to. And all of these companies, they are available in funds as well. So if you go to my platform, you will see that there are ETFs, exchange traded funds, which are created, and these funds are related to DNA sequencing, Internet of Things, health, medical, digital health data, electric vehicle space, digital payment. So all these kind of sectors, they're expected to grow. Even renewable energy sectors are expected to grow. This is 4 years of Democrats blue, Democrat Senate, Democrat House. So we are expecting a lot of stimulus towards encouraging renewables rather than fossils, right? So this is again one of the most important thing. Last section, before we move on to the 10 market factors which you should eye for 2022, the top 4 investment themes we should be looking at: financials, the banking stocks, the energy based companies, the mid caps, because mid caps will give you a balance between the cyclical and the quality exposure. So again, high growth and slow growth companies, right? So look at the mid caps more, and then reopening winners. Look at the companies which are related to leisure, which are related to hospitality, airline, flights. These are the reopening winners which you could see. So again, these four investment themes you keep in mind. Look at the US mid cap companies. Look at the energy based stocks, because oil prices as compared to previous 2020, it went up in 2021. It will expected to go higher. Again, as I said, not too high, but not too low as well. We are remaining neutral on oil, so it is not expected to go down too much. We are expecting consumer demand to go higher, supply to balance. So, and reopening in the economies will be good for the oil prices to remain stable. So, be keep a close watch on energy stocks as well, and on the reopening stocks also. So last of this slide, the 10 market factors you should eye for 2022. And this is the end of the section. And all of you, if you have any questions, continue to write, because this is where we end this session and we talk about 10 important things which you should, as an investor, as a financial consultant, you should look into this. The very first thing we are going to discuss is inflation. You should definitely keep a check on inflation, because when it comes to inflation, uh, there are a lot of strategists which are still sounding the alarm that food and energy prices, when they rise, they look at inflation. A lot of investors, they are thinking that this is just transitory, because the lockdowns have been removed, so a lot of pent up demand has started. But inflation is a very active topic. um, right now, bond market cares more about inflation than the stocks, right? Right now, you have to understand that if inflation goes too high, then you should be picking growth stocks, or you should be picking value stocks over growth, because higher inflation means interest rates might go up. And when interest rates go up, the value stocks, the ones which give you more dividend, are preferred more rather than the technology based companies. So inflation is something which you should keep a close check on. Second is the Federal Reserve policy, um, followed by what's going on with inflation. The Federal Reserve is expected to reduce down the stimulus, and which is called tapering, which means now less cash will be injected in the economy. And again, as I said, this can be really emotional for the stock markets, because stimulus is like drugs for an economy. So when you start removing those drugs, what happens to the equity market, right? So if it has not happened in 2021, you have to look out for 2022, the Federal Reserve policy. Weak bond returns, this is also something which you should see, because in the last 15 months, if you see the 10-year bond rate, it has moved from 0.5% to 1.6, right? The high yield bonds, if you see, they are yielding less, they once did. Now, there are two outcomes in 2022. Either bond portfolios will earn low positive returns, right? They will lose a little, or they will lose really lot. Uh, we have to see that bond markets at this point of time are not really attractive. And I have said this before also, that unless you are really old and you don't have a stable income, you're retiring. So that way, bonds could be a safer option to hedge against the volatility. But as of now, it's not really a good idea to look into the bond market. Followed by US fiscal policy. Again, now if you look at the US fiscal policy at the moment, uh, again, we can do a completely different session and discuss about that, how um, fiscal policy is related to taxes and infrastructure, how this is going to be work. But just to make sure, you need to be careful um, when you are picking any some such kind of investment, because fiscal policies depends on the political climate. Okay, and this is something which you have to be very very careful about, because increase or decrease in taxes, it depends on the government, it depends on how Congress reacts, and what happens with the votes. So as of now, fiscal policy is very unclear. uh, Retail investor, now retail investors, normally we so retail investors are anyone like us, for example. um, you have to be very careful, and I'm talking to the retail investors, I'm not talking about the institutions here. Understand the decision making structure. Please do not copy trades. So copy trades, robo advisory, this is not something which you should do in this environment. Okay, you have to take your own decisions. Even when a financial consultant tells you something, as I said in the very beginning, that you have to consult the experts but take your own decision. It is required that 2022 you should be very, very careful. And the current market right now and the volatility is very dangerous for you. So please continue to make sure that you do not invest into too risky volatile assets like cryptos. Have a stable portfolio which also has something called uh, fixed income stocks, like dividend based stocks, so you have a certain income coming in. Next, five sectors when what you need to be careful about is big tech stock dominance, post pandemic economic growth, market sentiment, earnings and equity valuations. Now here is what we need to understand is that there is the big tech stocks, like look at Facebook, which is Meta platform now. Look at Alphabet, look at Netflix, look at Apple. Right now these stocks, they constitute about 22% of the S&P 500. You look at Nasdaq index, these stocks, they almost constitute 41% of the index. So you have to see that when you are actually buying Nasdaq, you are still heavily invested in these five. Okay, so please do not just diversify into these five, because this is not a diversification, this is complete deception. Okay, you think probably that you have bought S&P 500 and your money is spread into 500 stocks. But what you don't see, and this is really important, investors, please think about this, because what you see is that if I put my money into S&P 500, my money is spread into 500 companies. What you don't see is that 22% of S&P 500 is made of these big five: the Netflixes, the Googles, the Apples, and Amazons, and Facebook. So even when you are invested into S&P 500, you're actually invested more into technology. There's a question: how much percentage of correction expected in Indian markets from the current levels? Outlook of Indian mid cap and small cap going forward. So in mid cap and small cap are expected. So from US, it is still expected to go higher. Uh, Correction levels. See, on a normal scale, 5 to 10% correction uh, is always good to enter. But at this point of time, even that kind of correction is not something which is expected. As we say, when we talk about buy on dips, probably 3 to 4% correction is still a good buy on dips. So just look for that. Don't wait for a 8-10% correction at this point. I'm going to give you a mid cap and small cap outlook going forward. Let me just finish this particular section as well. So, guys, as I said, please do not get fooled by the big tech dominance. Try to be more diversified. Look at the post-pandemic economic growth as well. So this is another factor which you need to be very careful. The pandemic, it changed our lives completely, and that was one of the most important thing was that lockdown, it disrupted the supplies, and that was the problem, right? The factory orders went down, consumer sentiments went down. Now when the Wall Street starts again, now when the lockdowns are over, so we will see again there will be a lot of sudden movements in the stock prices. So do not get carried away that that this is the growth happening. This is probably the old lot which is getting cleared. So be very careful. Do not get fooled away by the rising prices. Be very careful and check the valuations of the company. Then there is market sentiment. There is a lot of FOMO among investors. Talk about bitcoins. A lot of people, they entered into Bitcoin when it reached to 60,000 because they had a fear of missing out, right? So do not have that thing. Please be very careful. Cryptos are very speculative, very volatile. So market sentiment at this point of time, it's really, really fancy, if I were to say. People talk about alternative energy. They talk about cybersecurity, a lesser known commodity such as lithium. So just do your research before you enter into it. I just talked about thematic investing, right? Battery cars, EV space, a space exploration like Virgin Galactic, SpaceX. Do not get fascinated by this. So don't exhaust all your savings into these ideas. Understand the sentiment, and only then a smaller portion of your invested amount could be dedicated to these things, right? Then we talk about equity valuations and corporate earnings. Again, valuations, as I say, um, we have to be very careful. Uh, there is a lot of support which has been given in last 5 years by Federal Reserve, and the valuations have increased. But again, there are a lot of investors that try to justify market valuation levels, that this is inexpensive, you can still buy. Right now, equity valuations are high. It can stay high for a while, but again, reality will matter. Okay, so please make sure that do not get into the herd mentality and go towards the Facebooks and the Amazons, as we always do. Just be very careful with the valuation. Right now, the equity valuations are high, and we have to see those that way. Right. So this was something which I wanted to discuss today with the outlook. Now, again, if you want to have something, want to have a one-on-one session, I'm ready for a one-on-one session. I can even discuss about what is expected, how to use the platform, further dive into what's going on with the dollar. We can look into technicals. This is something which is really important, guys. Just look at this. This is the last slide before I end this. This is the capital market line as of 30th September. So as you can see, the horizontal is the expected risk percentage. The vertical is the expected return. So capital market line is a concept where any asset above or on the capital market line denotes the optimum risk and optimum return. So if you see the asset classes which are below the capital market line, are probably not the ones the best investment. So if you see Chinese equity A shares, so this is really interesting, guys. Spot this up. This is the last thing I want to discuss. See at the bottom, extreme right, there is Chinese equity. See where it lies on the capital market line, way below the line, which means high risk and less reward. Look at the risk and look at the reward, right? And then see Asian equity, emerging market equities. It is right there on the capital market line. Look at the above market line. What are the above market line? Look at the UK mid cap, the US cyclical stocks, US equities. They're still above the capital market line, right? Something which you can look into. So at this point of time, mostly if you see investments related to Nasdaq index, investment related to emerging market stocks, gold futures, they are still at the capital market line, which means optimum risk, optimum return. But if you look at US defensive sector, it is you look at US government bond and US high yield bonds. Government bonds, again, it is extremely on the left side because the interest rate, the depends a lot on the interest rates, that how the returns are. So it's a kind of risk free return what the treasury bonds give you. So this is extremely on the left side. But as it increases, look at the important ones. The US equity are on that line. um, Real estate is on that line. Japanese equities are on that line. Private infrastructure is on that line. Private equity is on that line, right? German equities are also on that line. But however, if you see Chinese equities, US equities, small, broad, those are something which are still falling below, which means higher risk and lower return. So the capital market line tells you the investments which are optimum risk, optimum return. Because when you take a certain amount of risk, you would expect a certain kind of return. Now, again, this is as of 30th September. This is expected to change over a period of time depending on the risk and returns. But as I said, that when you talk to our consultants and when you talk to your risk experts, this is the research which gets carried forward, and we this is how we come back to you. So this is, guys, this is what I wanted to discuss today. We have a live platform as well, but I'm sure there's a time constraint. All of you have been very patient with me. A lot of you have asked your questions. Some of you still asking about possibility of a demo account. Um, Demo accounts are available. You can talk to your relationship managers, and they will be able to provide you demo accounts also. How to open live accounts? Live accounts are again very easy. You can always open a live account within 2 days, so that's not a problem. Are you available for a one-on-one session? I'm available for a one-on-one session. Just uh, the first introduction might be done by the relationship manager because I'm in India right now. I'm getting married on 27th, so this is my last session for the November. After this, I will come back in December, and I'll be more than happy to do a session for you. So definitely, I'm available for a one-on-one session. Probably not this week, but definitely next week starting. I'll be available. So if you have any questions, you want to understand how to invest into um, uh, theme-based companies, if you want to invest into bonds, if you invest into commodities, I will be available for one-on-one sessions. But right now, your relationship manager is capable of giving you a platform training. So if you want that, please talk to them, and they will be able to give you that. After I'm back, I'll be more than happy to arrange a one-on-one session for you where you can discuss more, talk about different sectors. If you want more and more research, I can definitely sit and bring my researchers also on board, and we can have more fruitful discussion about how this will be carried out, right? Before I leave, on behalf of Century Financial, my team, and my family, a big vote of thanks to those people who are connected to healthcare and medical sector, doctors, nurses, midwives, first responders. All of you have shown so much courage during the pandemic. It is still a tough time for us, and I owe my life and health to all those brave people who have been out there and risking their lives for us. So if you are one of them, thank you so much. If you know such people, if you are related to these people, your husbands, wives, fathers, mothers, siblings, if whatever they are doing, if they're into medical industry, a big word of thanks to them. Please convey my regards. We'll meet really soon next week, probably with a different session. There is another session on technical analysis. You can check Century's calendar, and it will be tomorrow or day after. You can check and attend those sessions as well. We do these sessions to make people more and more aware about what's going on in the markets. So next week onwards, we'll have different sessions. We'll have one-on-one trainings. Stay tuned, be invested, and please talk to us. We'll have more and more information to you. My name is Yogesh. Thank you so much for attending this. You have a great night, and if we do not meet in December, a great November to all of you. And there is a National Day weekend coming, so I'm sure that all of you must have planned this out. So have a very safe trip, have a great journey, and let's be connected and talk more.